We've got another real-life business problem for Rocketblock's experts to solve in today's mock interview. Today's interview asks a timely question. What do you do if the regulatory rules in your industry change suddenly and dramatically? Watch as our experts break down this big, scary problem using a methodical approach to help the client understand what to do next. As a reminder, if you want to be the kind of person who can figure out what to do when an industry faces big changes, you need to actively practice problem solving. At the very least, pause this video each time Maddie asks a question and practice speaking your own answer out loud. And when you're ready to get serious about practice, come to Rocketblocks to build your problem-solving skills for real. Good luck and have fun casing.
Cargill is a major global supplier of food ingredients, including food colorants used by large North American CPG, consumer packaged good companies. These colorants fall into two main categories. So we have synthetic dyes, which are low cost, shelf stable, and widely used in mass market products. And Cargill produces these in a facility in China. And natural dyes, which are derived from plant sources such as turmeric, beetroot, spirulina. These are more expensive, they're less stable, and those are currently manufactured in smaller volumes in both China and Mexico. In response to shifting consumer preferences and regulatory scrutiny, Cargill is considering two main decisions. Should they discontinue its synthetic dye product line and shift its focus entirely to natural dyes? And if Cargill does shift to natural dyes, where should it consolidate and expand its production? China, Mexico, Ireland, or the US?
Got it. Okay. So just as a quick recap to check my understanding, our client is Cargill. They make
Yep.
food ingredients, and one of their business lines is food dye. So they make synthetic and natural dyes. The synthetics they do in China, the natural they do in China and Mexico. And it
Mhm.
sounds like they make more of the synthetic than they do natural. So synthetic is a bigger part of the business line. So from an objective standpoint, the synthetic product facing some regulatory scrutiny and customers are shifting away from it. So they're looking at two topics here for us to dive into. The first is whether they discontinue the synthetics entirely and focus only on natural dyes. And if they do that, the question is where should they manufacture the increased production of naturals? Is that China, Mexico, Ireland, or the US? So is that right?
That's correct. The only thing that I'll correct there is that about 40% of Cargill's food dye revenue comes from its synthetic dyes. The rest are from all natural or a blended solution of
All
synthetic
right.
and natural.
Got it. Okay. That's a helpful clarification. Um, and maybe just one additional question then before getting into a structure here. I'm hoping to just confirm the geography. Is this like an international company from a customer standpoint?
Cargill is an international company, so while they are headquartered in the United States, they do have um,
Mhm.
customers all over the world and produce for
Okay.
customers all over the world.
Got it. That's really helpful. So I have a bunch of other questions, but I think I can just get to them in my structure. So do you mind if I take a minute and just put my thoughts together here?
No, take your time.
Love it. Thank you. Okay. So I have a structure here with two buckets,
Okay.
if you can see this here.
Yep.
So the first is what I'm calling threat analysis, and then the second is about locations for manufacturing if we decide to focus on that natural product. So within that first bucket of threat analysis, I'm thinking of three areas to look into. The first is really around the market and customer trends. So this is kind of the market size for synthetic versus natural and some of the trends about you know, from a spend standpoint, where that's going. The next is regulatory. So I'd want to understand things like what agencies regulate both kinds of dye right now, what changes have happened, and how has that impacted the business? And then what kind of regulatory changes might we expect in the future? And the kind of costs to comply with any future regulations. And then this last bucket here is customer preferences. So this is really targeted around the Cargill customer base as opposed to the market and around Cargill sales of synthetic versus natural and the trends that we've seen over the past 5 years. And then just from a perception standpoint, like, if there are trends happening, why are the customers doing that? How do we feel about that? And then just some general thoughts around like reputation, perception risks, sustainability goals, and that kind of more qualitative aspect. And then the second bucket here on locations for manufacturing, I'm thinking about this in three sub buckets. One is the cost to manufacture for whatever location we pick. So that's things like the CapEx to set up a new plant, the COGS, basically like raw materials and labor in the plant to manufacture the dyes. Then there's a second kind of logistics bucket around transportation to our ultimate customer base, and what the infrastructure to do that looks like in each country. And then the last piece is around risks and regulatory. So, what the government looks like and the regulatory regime looks like in each country, societal stability, and tariff risk in general.
Okay. Yeah, that makes a lot of sense.
Here's some feedback from Maddie. This is a multi-step case with 2 questions embedded in one. It's good to pull these kinds of prompts apart so they can be tackled one at a time. It was helpful to see the visual of the structure, and even if you don't have a drawing, your mental map and explanation of your structure should be good enough that the interviewer could draw the framework if she or he wanted to. For a case of should we do X, it's helpful to spend time considering alternatives. So if we didn't switch to natural dyes, what would that look like for Cargill? What is the counterfactual?
Where would you like to start, Chris?
For me, I'm thinking, I'd want to go with my first bucket here. For like threat analysis, it's about trends in the market. Do we have any information about like what trends we're seeing?
We do have some. So I'm going to go ahead and share my screen here. So an internal Cargill report has summarized some of the key information about the synthetic versus natural dyes. You see this okay?
Yep, that's coming through.
Okay. So number one, what percentage of revenue should Cargill expect to retain if it switched to natural dyes? And then how should this information impact Cargill's decision whether to continue or discontinue its use of synthetic dyes?
Got it. Okay. So, yeah, why don't I start reading through these exhibits here? The first exhibit up top, I'm seeing this is called Synthetic Dye Financial Snapshot 2024 Forecast. Okay. So I'm seeing revenue for synthetic dyes is $120 million. So that's a pretty decently sized business line, I'd say. Gross margins 45%. I guess just as a quick calculation, 120 times 45%, that looks like that'll be $54 million of gross profits. That's also, it's a pretty good margin. Volume growth, -2% CAGR from 2020 to 24. So it's not a fast shrink, but it's enough to be concerned about. And then we're seeing 65% of customers shifting away. So from this first exhibit, I think this is a pretty concerning picture. We have a pretty large and profitable product line, shrinking at 2% with 65% of customers walking away. Those are 2 very concerning trends. And to me, I mean, these numbers seem to validate that we would want to take action here. If I move down to the second exhibit, this is customer retention scenarios if Cargill exits synthetic dyes. So this sounds like it's tied to that question that we got asked up top. So this is all about moving to natural dyes, I take it. So there's a table with 3 rows showing some customer segments. And for each, we have their percent of revenue and the expected retention via natural dyes. Good. Okay. So for this first segment, large CPG, that's 50%. So most of our revenue, and we'd expect 80% to remain with Cargill if we switch to natural dyes. So that's a pretty positive picture, to be honest. If your largest customer group is mostly going to stay with you. The next segment, mid-market food companies. So 20% of revenue with 50% retention. And lastly, the price-sensitive segment, 20% of revenue, 20% retention. So it seems like this group would mostly be walking away from us here. So here I'm seeing Cargill sells mostly to large CPG companies. They seem to be the least price sensitive and the most motivated to use natural dyes and would switch with Cargill. So I guess answering your question, I'll just do some quick math here. I'm gonna set up some equations and we can take a look. Um, okay. So I've written out some equations here with three rows corresponding to those segments. So for CPG, we've got the 50% times 80%. That gives us 40% ultimate retention. For mid-market, it's 30% of revenue times 50% retention. That brings us to 15. And then that price-sensitive group, it's 20% times 20. That gives us 4. If we sum that, that's 59%.
Okay.
So basically, 59% of the revenue would be retained. So I guess that's not a great result in itself. I mean, it means that if we immediately discontinue synthetic and went to natural, we would have about 60% of our revenue. Um, but I guess the hypothesis here would be that, the business line is shrinking anyway, and the
Mhm.
natural side is probably experiencing some pretty strong growth trends. So, I think we could make a case to switch now based on what those trends are showing.
Yeah. What pieces of information are kind of highlighting that for you, Chris, that customers are shifting away from synthetic towards natural?
Well, to me, if we look at Exhibit 1, we're seeing 65% of customers shifting away.
Hmm.
That doesn't necessarily say we're going to natural, but it means they're shifting away from synthetic.
Yep.
Um, and maybe there's information. If we look at this last exhibit, Exhibit 3 here, this is saying regulatory and consumer landscape. So here we've got some trends and 2024 observations.
Hmm.
So going through this, the first row here, California and EU policy, we're seeing a ban on red 3 and yellow 5, 6 under review. I'm assuming those are synthetic dyes.
That's correct. Yeah.
Um, yeah, I guess that's concerning to me. I mean, California and the EU are both big markets, so I'm sure they're important for Cargill's business. The second
Hmm.
row of consumer attitudes. So we're seeing 68% of customers see synthetic dye as a red flag. So I mean, that really answers your question. Of if we're seeing 68% of the customer base who just does not like artificial coloring, um, the corollary there would be natural is probably preferred. Um, Third row, clean label CPG formulations seeing 14% growth year on year. So that is a confirming data point, right? That's a pretty clear growth trend for the natural product. And then the last point here, CPG reformulation investment, high brands actively phasing out synthetics. So I take this to mean CPG companies, that's Cargo's largest segment, they're investing
Hmm.
a lot in reducing synthetic dye use.
Yeah. Yeah. You're spot on there.
Um, Okay, so to me, this is really confirming that there are regulatory forces that are both like creating a drag on the synthetic product, but then we
Hmm.
also have this consumer preference that gives like a positive trend for the natural product. So really, I would say like my hypothesis is that Cargill should switch its business to natural dyes.
Great.
Mhm.
Well, thanks for walking me through that, Chris.
Here's some feedback from Maddie. Chris does well to step through each table one at a time, describing the data and pulling out mini insights from each piece of information as he goes along. There was an opportunity to be a little more clear in what calculations Chris was doing and why in advance of executing on the math. When prompted, Chris was able to pull data points from all three charts that indicated people are switching away from synthetic dyes and towards natural dyes. He connects these points back to a core hypothesis that Cargill should switch away from synthetic dye manufacturing.
So, the recent news about tariffs has created concerns for both Cargills and the companies that they supply. And everyone is worried how tariffs might impact their organizations, people, and their profits. What are some of the main considerations Cargill should look into to decide where they should be producing their dyes? Not necessarily what locations, but what should they be considering before they choose those locations?
So some of the general considerations here.
Yeah,
Okay.
exactly.
Um, Well, why don't I call back to my structure? I'll bring this up again here, but if you look at this second piece here, that's all about the locations. So I had these three
Hmm.
buckets around cost, kind of logistics, and then risks and regulatory. So I think it'd be good to go through each of those.
Yeah.
First up, like up top on cost, um, I see a few different sub buckets. The first would be CapEx and startup costs. So under that, I'd be thinking about like what is the cost of land? Like how cheaply can we, get a facility? There's the equipment costs of how much does it cost to buy all the equipment we need and get it shipped to that location. And then there's also, if you want to buy an existing building, maybe you're retrofitting something, like how easily can you retrofit a building? So that's really about the factory aspect. There's another important aspect of COGS, right? Around like raw material cost, labor, and basically the kind of operations and maintenance O&M costs to just get the materials and the dyes themselves produced. Um, and then you mentioned tariffs when you introduced the question. I think, it opens up a whole bucket around maybe tax credits, investment credits, and then the flip side of that being tariffs and what kind of, penalties might you see, financial penalties like a tariff for doing business in that country. Um, so those are some ideas on that first cost bucket. The next one I have as logistics. So I'm thinking about um, really two things. The first bucket on logistics is like, where is this country in location to our customer base and where they're located, right? If the bulk of our customers are located in North America, it might be better to have the plant located somewhere in North America, like Mexico or the US, versus if, having it in China where there's just um, it'd be more time consuming and potentially more expensive from a logistics standpoint. The other thing too is just kind of general infrastructure quality and the ability to get ingredients in and out, like get raw materials into the plant to get them out to the world market. And then this last bucket here of risks and regulatory. I think this is really important. I think, government and regulatory is going to be key. Like, can we get permits easily? Is that a transparent process? Is it a timely process? Or is it going to take, many years to be able to set something up? Um, that's important. There's another bucket around, say, societal stability. Is there any risk that, just any risks in general that could disrupt our operations? And then
Really
from,
quick
I guess, oh yeah,
there,
go ahead.
Chris. How are you measuring societal stability? How do you think about it? What sort of metrics
Yeah.
might you be thinking about? Yeah, how do we judge that?
Yeah. I mean, that's a good question. I mean, one thing I would think about is, there's a binary question about like, is this a democracy or not? Is this a country where there's a huge amount of satisfaction among citizens? I know there are annual polls across the world about like, hey, are you happy or not? Like just kind of like a happiness index. Do you see a lot of widespread protests to try to displace a sitting government? Um, Basically, you want a sense that you can do business in this country and you're not kind of at risk of your investment and your operations just going under.
Yep.
Yeah. I think that, under that last category of risk and regulatory, I would also want to talk about tariff risk again, that
Okay.
you brought up. And this is another thing that I think is really measurable, which is, across the different countries that Cargill interacts with or where they have a market, what does tariff risk look like in those countries, right? Um, and that's just like a purely quantitative number that you can come up with.
Yeah. I think those are great buckets, and a really helpful brainstorm. Thank you for walking me through all of that.
Here's some feedback from Maddie. Chris does well to start this analysis by picking up where he left off in his introductory framework. Cases will sometimes bring you deeper into questions or ask for reanalysis based on new information. In these situations, if your original framework was strong to begin with, you should be able to go back to it to continue the case. With a strong structure in place, Chris does well to color in each category with details that are creative and applicable to the case. The beauty of a MISI framework is that it allows you to flex your creativity inside the boundaries of a simple, rigid structure.
As I mentioned in the prompt, Cargill is currently producing their dyes in China, and they've identified three potential alternatives to producing in China: Mexico, Ireland, and the US. Where should they produce their dyes and why? Can you see my screen okay?
Yep, it's coming through.
Great.
Okay. So just looking at this here, I see two different tables. So I'll start with the top one. This looks like it's cost components, and the four columns are the four different countries we're looking at: China, Mexico, Ireland, and the US.
Yep.
So we've got a pretty good list of different cost components here. I think really to make sense of this, I would just need to sum these up and get a sense of what is the total cost per country. So why don't I go ahead and do that here?
Yep.
Okay. So I'm just taking a quick second to do some math. Okay. So I'm assuming these numbers here are probably, it's a cost per some kind of unit, like cost per pound or cost per kilogram.
Yep, that's
Um,
spot on. It's cost per kilogram.
Cost per kilogram. Okay. So I've come up with some numbers here. Basically, I'm getting for China, $8.6 per kilogram. For Mexico, also $8.6 per kilogram. Ireland is 10.4, and the
Hmm.
US is 10. So that's really interesting. I'm seeing basically China and Mexico are tied for a kind of lower cost option.
Yep.
And then you have Ireland and the US are both about $2 more or $1.50 more. So it's more of like a high cost option. My kind of general hypothesis here would be is that you have China and Mexico, a lower cost option, but there might be more country risk associated with those two places. And then you have Ireland and the US, a higher cost option, but it feels like they're maybe less risky geographies. Um, but when I look down the page here, there's a second chart, Exhibit 2. It looks like this is more qualitative. So let's get into that.
Correct. Hey, Chris,
Um,
one thing just to stop you here. You talked
yeah.
about a certain cost that isn't listed here. What is that cost? I think you were talking about
Mhm.
maybe startup costs, right? Or what would you hypothesize between Mexico, Ireland, and the US in that
Mhm.
regard? How do you think those three would compare?
Oh, got it. So basically you're saying these are the kind of cogs to make the product, but we're not looking at any upfront CapEx to,
Yeah.
get facility up and running. That's a good point. I mean, my hypothesis here would be China and Mexico is probably cheaper and faster to get something set up.
Hmm.
The general trend over the last 20, 30 years has been companies are setting up more manufacturing in China. It sounds like it's a pretty quick process to do that. Ireland and the US, I imagine land cost is more expensive. Labor costs tend to be more expensive. I think getting a facility up and running would be more expensive and probably a little more time consuming as well.
Yeah. I think you're spot on there. Okay, sorry, back to you. You were
Yeah.
about to walk me through the second chart.
Got it. Okay. Well, these are some qualitative factors, maybe along the lines of what we were just talking about here. Um, so here we go. We've got the four markets again. So supply chain risk, if I just kind of read through these each quickly, supply chain risk, China's the highest, Mexico is medium, and then we have low for Ireland and the US. That to me, I guess when we say supply chain, that's just a general risk of, does that include, say, country risk or? What would we describe supply chain risk as here?
Yeah, how much can we rely on this supply chain? I think,
Mm,
if we think back about 5 years to COVID, um, how easy is it to get things? I also think the supply chain risk there is really going to play into that tariffs and compliance. I know right now
yeah,
at the ports of Los Angeles and some on the East Coast, there's no ships coming in right now
got it.
from Asia. So, how much can we rely on these
Got it.
products to kind of continue on?
Okay, that's really clear. And it makes sense to me that Ireland and the US have lower risk on that standpoint. Next is customer perception of like the clean label aspect. So low perception for China, medium Mexico, high for Ireland and the US. So I guess we're seeing that Ireland and US would maybe justify more of a premium kind of marketing effort there.
Hmm.
Um, Access to skilled labor, medium in China and Mexico, high in Ireland and US. That's interesting. I'm not sure how much skilled labor is involved in this, but if it is, it sounds like we'd have a more ready labor base in Ireland
Yep.
and US. Regulatory stability, so higher in Ireland and the US, low, medium in China and Mexico. So I guess that probably comes back down to like the country risk and how easy it is to do business there. Time to scale capacity, so short and medium in Mexico, you could start up a lot more quickly there. Long, medium in Ireland and US. Okay. So that kind of validates my hypothesis that we talked about before in terms of
Hmm.
startup. And then alignment with CPG customers. So that I guess is a reference to our largest customer group, the CPG group. Low alignment from China, medium Mexico, and then high in Ireland and the US. So I think really this chart kind of validates my initial perspective here that we have a lower cost group in China and Mexico that carries a little bit more risk to it.
Hmm.
But it could potentially be more profitable for us given the lower cost. Then we have this higher cost group in Ireland or the US that brings less risk overall. Um, I think, based on this, we could filter this down a little bit more because I'm seeing China and Mexico have the exact same cost, but um, it looks to me like there are some risks in Mexico that we don't have in China, or at least, it's like a shorter spin up time to get these facilities up and running. I would suggest just scrapping Mexico as an option.
Okay.
And then between Ireland and the US, um, there's also some similar factors here that I think we can use to rule out Ireland. Like first, it is the most expensive option at 10.4, and the time to scale capacity is long versus the US being medium. So I think we can bring this down to just China and Mexico, and we have these two options of like a lower cost versus a higher cost model.
Here's some feedback from Maddie. In this case, Chris was able to go back to his original framework again to explore startup and capital costs. Chris's framework was more complete than the data that was presented in this exhibit, and it's sometimes important to call out what's not shown in a chart when you're looking at it, especially if it was an important part of your structure or framework. Chris did well to summarize the takeaways from the two charts to help identify how to balance cost and risk across the four geographies. When given a chart with a lot of data, it's important to identify which data points are most important. Chris spent a lot of time in the weeds on the second chart, and there was an opportunity to highlight which fields are most important for the client and speed to an analysis a little bit quicker.
Okay. All right. So Cargill senior executives are ready for your recommendation. What should they do about their dies?
Okay. Do you mind if I take just a minute to collect my thoughts?
No, go for it.
All right. Thank you. Okay, so my headline recommendation is I recommend that Cargill move to exit the synthetic business and focus on natural dyes, and that they shift production to the US. So this recommendation is based on some of the trends that we saw showing that our largest customer group, the large CPGs, are shifting away from the synthetic product, and that we can retain about 60% of our business if we switch to the natural product. I'm recommending the US because even though it's a higher cost location, which might impact our margins, I think it's worth it given the reduced country risk and the fact that we're making such a big shift to the portfolio. Being able to rely on the host country for manufacturing will be beneficial in the long run. I think it does bring risks, though, especially in the margin aspect that I mentioned before. So I think as a next step, it'd be worth conducting an analysis within the existing customer base to understand how they would perceive the change and if we could justify any kind of a price premium for a natural US made die that would help reduce that margin compression risk.
Great. Thanks, Chris.
Here's some feedback from Maddie. Chris does well to explicitly answer both of the original questions in the prompt that were covered 20 minutes ago at this point in the case. His recommendation is clear, with a specific move to exit from synthetic and recommendation for US as a country of manufacturer.
Hey everyone, it's Kenton Kavesti here, the founder of Rocket Blocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocket Blocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocket Blocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.